going on, fellow investors? I thought I'd do an educational video talking about investment philosophies and the detrimental importance it is for each single investor to have their own investment philosophies. One of the most common mistakes I see among all new investors is they want to get into investing straight away, but they don't have a contingent plan in place. They don't have a philosophy in which they maintain. And as we all know the saying, it is much easier for a storm to blow away a house on weak to no foundations than a house built on strong foundations. And that is very much the same principle in which we use from a first principle basis when it comes to investing. It is important as investors, we have our own philosophy, we have our own blueprint in which we follow. And all of the world's most successful investors, hedge fund managers from the likes of Bill Ackman, Peter Lynch, the late Charlie Munger, Warren Buffett, or even Bill Ackman, all have their own philosophies in which we will get into. But I thought I'll go through some of the most common philosophies at the moment, and maybe you guys can sit down and actually analyze your portfolio and ask yourself which one of these philosophies best resonate you. Number one is obviously the most common, which is value investing. And I think Warren Buffett is an absolutely exceptional example of this. It's effectively investors going out there, buying great businesses at very lucrative valuations. And we want to be getting good valuations for two reasons. First, we want to get bang for our buck. We want our money to go into a stock which the market may have sold off or maybe mispriced. And if we can get a stock where the current trailing price is way below the intrinsic value, it means there's really good potential upside in which that stock can go up on. And it also presents us with a margin of safety. God forbid that stock goes down because of bad market sentiment or maybe a bad one-off earnings or whatever the reasons may be. If we're getting good businesses at good valuations, it covers us in terms of margin of safety. It gives us a little bit of leverage in which we can operate on, and it gives us much more exposure to a higher potential upside. Number two is growth investing. These are individuals that go out there and they're not too bothered about the current intrinsic value or the current valuation of a business. They are more worried about not what the share price is today, not what the valuation is today, but what the valuation is going to be 5, 10, 15, 20 years from now. And that is very much the same principle in which we like to use when it comes to growth investing. It's picking stocks which we think have a huge potential future upside, where there's a lot of catalysts going for the business long term, and they are the stocks and the philosophies in which we want to double down on. Number three is index investing, and this is probably the most common form of investing I see among most investors. It's individuals going out there and they are buying index funds, whether that's the Nifty 50, the S&P 500, the FTSE World, the FTSE 100, the Nasdaq, whatever index fund it may be on whatever stock exchange it may be. These are individuals going out there buying index funds because they understand that it is very hard to beat the market, let alone compete the market. And if you can't beat the market like most people can't, it might be better to buy in the market and become the market rather than trying to beat the market. These are individuals that like diversified portfolios. They like exposure to different sectors, different economies, different industries, and subsequently they have a well-balanced, low volatility portfolio where over the many years and decades it can compound to be quite a significant amount of money in the long term. Number four is dividend investors. I have a very good friend who absolutely loves to buy dividend stocks. Coca-Cola, Google, Microsoft, AbbVie, Lockheed Martin, you name it. If it's paying good dividends, he is going out there and buying it. Dividend investors are very simple. They are investors that go out there, they look at stocks which pay them a dividend, which basically pay them a small percentage each year off the value of the share price, and they can make a good little side hustle from that. And some individuals can go on and do very well. There are some investors out there that have been more investing for many decades, and they are literally retiring early because of dividend payouts. And it's basically a second stream of income. It's nothing better than being a shareholder in a business. The share price does well, the business does well, and in exchange you get a very small percentage as a thank you from the business for being a current shareholder in the business. Number five, a bit more technical, is quantitative investing. These are investors that go out there and they effectively use tech, they use software, they use algorithmic investing, and they look at different charts, whether they're looking at SMAs, EMAs, moving day averages, support resistance levels, and their software, their financial engineering will basically tell them what are the best stocks to go out there. This is a very technical form of investing. Not many people are qualified to do this. It can be a very lucrative form of investing if you know what you are doing. Number six is my favorite investing. I'm probably a very good example of this, and that is called asymmetrical investing. Asymmetrical investors like myself are very simple. We are investors that go out there and we look for stocks that by today's standards could look undervalued, compared to where they could be 5, 10, 15 years from now. We are looking at stocks that we really generally think in 5, 10, 15, 20x. We're not gambling, we're not buying crappy penny stocks or meme stocks. We're going out there buying good businesses at good moats, good fundamentals, good financials, good thesis, with a good element of growth aspects. And we generally believe that we think these stocks can do a hell of a lot better than they can do worse. And we want to make sure that the potential upside is significantly more than that of the downside. That looks like a very compelling linear lineup, and that is what asymmetrical investors do very well. I've done this with Palantir, I've done this with Bloom, and right now I do have a few very high asymmetrical bets in my portfolio that I actually really generally think could go on and do potential wonders, but only time will tell. Number 7 is contrarian investing. Now this is quite an interesting form of investing. These are investors that sort of do the opposite of what the market wants. If a market is up, it's ripping to all-time highs, everyone's euphoric, everywhere is green, these investors get a little bit cautious. They think it's too good to be true. Valuations are getting overextended. Businesses are sort of being almost priced into perfection when it comes to their earnings, and they are more likely to sell when the markets are green, and then more likely wait patiently and buy the market when the market dips. So when everyone's panic selling, these guys are buying, and when everyone's excited, euphoric because the markets are up, these guys are quietly selling. And the reality is, it's all about patience. It's patience, it's for stomach, it's for willpower. It's very much a psychological game. And as I say to all investors, in this life, we are going to make money through two ways and two ways only. You are going to make money by physically exchanging your time for money and working physically hard for the money, or you are going to do it mentally. And the stock market is nothing more than a mental game of casino. And I will say one thing, fair play to contrarian investors, because they do have the mental resilience to be patient and to selectively calculate as and when they make these purchases and sales. Going on to number 8 is factor investing. Now this is a very interesting form of investing. It's very subjective. There's not actually a particular way in doing it, but factor investing is basically investors that go out there and they look for specific factors in specific stocks in which they want to invest in. These are USPs. These are almost unique selling points that make these stocks individually different to each other. It could be that the stock is low volatility, so it's got a low beta level. It could be small cap stocks. It could be specific stocks that have specific fundamentals that they like, maybe specific singularity scalars or specific ontologies in which these systems use. So these are basically investors that go out there and they are nitpicking at tiny little things in specific businesses that they really well. And the reality is each different one of their positions are very similar to each other, and they are looking for unique fundamentals that differ between most of what other investors are looking at. And last but not least is momentum investors, probably one of the more aggressive forms of investing out there. And these are the typical example of buy the rumor, sell the news investors. These are investors that go out there, they buy stock once there's already momentum, once everyone's talking about it, once everyone knows who they are, once it's on the front of Bloomberg, CNBC News. They are the guys who are out there buying the stock when there's a lot of hype and euphoria out there. Basically, they're jumping on board on the rocket ship once it's taken off, and their job is to get out once it hits orbit and the stock potentially drops. And that is very simple. They are more likely referred to as swing traders. They're there, they're buying the stock, but with a very short-term time horizon. They're scalping as much profit as they can get, and then they will jump ship, make their money, take their profits and invest it elsewhere. And I will always encourage any new investors, sit down for an hour or two, look at these different investment philosophies, sit down and ask yourselves, what am I comfortable with following? What is my risk appetite? What is my time horizon? What is my financial circumstances? What is the financial freedom in which I want to get through investing? What experience do I already have in the market? Because there's always going to be a different philosophy for different people, and there is no right or wrong answer, but the right answer you will find time and time again is what is best and what is right for you as an investor, and only you will know that. But I will also encourage other investors to not go out there and try and be a bit of everything. That never works best. Don't try and be a jack of all trades and result in simply being a master of none. Look at one or two, maybe even 3 of these different investment philosophies and think, how can I implement them in my day-to-day investing? Because investing needs strategy. Everything in life needs a plan. Football teams go out there and they win games not because of luck. They go out there because they had a plan and they stuck to that plan, whether that's in the form of formation, whether that's in the gameplay of ball passing. Houses are built on building plans, and same with investing. Investing is all about plans, and it is the people that have a plan on day one. They are the people that will weather the storm, and when these market turbulences come, they are the people that are not going to panic sell in the red, and they are the people that actually know what they want to achieve, and they know how they're going to achieve it. So sit down, guys, and as always, no financial advice is given. These are just some of the many financial investing strategies in which we can use as investors. Sit down, look at your portfolio, ask yourself some serious questions, and then come back and build up your own philosophy as investors. As always, fellow investors, no financial advice is given. Do kindly give me a like, follow, save, and a repost if you can. As always, bye-bye.